They promised a revolution, a way to opt out of the corrupt, centralized financial system. But in 2024, crypto did something shocking. It begged to be let back in. The ultimate approval arrived. The Bitcoin ETF, Wall Street's stamp of legitimacy. Financial freedom, now with a ticker symbol. But what if the greatest trick the crypto revolution ever pulled was convincing you that beating Wall Street meant joining it? This isn't a conspiracy. This is a baton switch, hiding in plain sight within the prospectus. Welcome to the institutional capture of decentralization. Let's start with the fundamental deception. The entire value proposition of Bitcoin was self-custody. Your keys, your coins, no middleman, no bank. The ETF completely annihilates this principle. When you buy shares of IBIT or FBTC, you don't actually own any Bitcoin. You own a financial derivative share in a fund that claims it holds Bitcoin. You get exposure to the price, but you surrender every single revolutionary feature. You can't use it as digital cash. You can't move it to a private wallet. You are 100% dependent on a new, even more powerful middleman like BlackRock, Fidelity, or Vanguard and their promise to actually hold the asset. You've traded digital gold for a digital gold receipt, issued by the very institutions crypto was designed to bypass in the first place. You are 3 layers removed from the actual asset itself. Here's the next layer of the scam, the liquidity illusion. ETFs are praised for bringing massive liquidity to the crypto market, but this is a dangerous magic trick. The ETF shares trade on traditional exchanges with massive volume, which makes it seem like Bitcoin itself is more liquid. In reality, most of this trading is just paper, Bitcoin. It's investors swapping BlackRock's IOU for Fidelity's IOU. This creates a dangerous divergence. The real Bitcoin, the stuff sitting in vaults managed by custodians like Coinbase, is becoming increasingly illiquid and concentrated. Some estimates suggest that ETF issuers and their custodians could soon control over 30% of all available Bitcoin. This isn't decentralization. It's the greatest centralization of the asset in its history. It creates a single point of failure that makes the entire system vulnerable to manipulation, a regulatory attack, or even the collapse of a custodian. The trading volume for ETFs skyrockets, but the actual on-chain settlement volume, the real movement of Bitcoin, stays flat. The two are dramatically pulling apart, and you always have to follow the money. The real winners of the Bitcoin ETF aren't the investors. They're what we can call the new crypto Middleman Industrial Complex. BlackRock takes its management fee, which is around 0.25%. Coinbase takes a hefty custodial fee for holding the coins. The authorized participants and market makers, the firms that help create and redeem ETF shares, they all take their slice of the pie. This creates a perpetual, risk-free revenue stream for Wall Street, whether Bitcoin goes up or down. If Bitcoin's price rises, they just collect fees on a larger asset base. If it crashes, well, they've already collected their fees along the way. Their incentive isn't for Bitcoin to succeed as a peer-to-peer system. Their incentive is for inflows to their ETF to continue. They have now aimed their massive marketing machines to promote Bitcoin as an ETF, actively steering billions of dollars away from the underlying owner-controlled technology and straight into their fee-generating wrapper. This all leads to the ultimate, devastating play, the regulatory trap. By bringing crypto onto regulated exchanges, the ETF doesn't legitimize crypto on its own terms. No, it invites the full force of securities law right to its doorstep. The SEC now has a direct lever to pull. By approving the ETF wrapper, they haven't approved the asset itself. What they've done is create a precedent that the only acceptable way for mainstream America to access crypto is through their regulated, surveilled, tax-transparent, KYC, and AML-heavy channels. It's a regulatory bait-and-switch. Adopt our framework, or get ready to be declared an illegal security and sued into oblivion. The rebellious, permissionless spirit of crypto is being systematically caged inside the world's most permissioned system. It's like luring a wild animal into a cage with a tasty treat and then slamming the door shut. So, is it a scam? In the strictly legal sense, no, it's a compliant financial product. But in a philosophical and structural sense, it is a profound betrayal of its first principles. It is a bait-and-switch that uses the brand name Bitcoin to sell a product that completely neuters Bitcoin's core innovations. It centralizes control, it creates systemic risk, it enriches the old guard, and it invites the very regulatory capture that crypto was supposed to help us escape. And here's the greatest irony of it all. The Bitcoin ETF might be the very thing that saves Bitcoin's price in the short term by pumping institutional money into it, while simultaneously killing the reason it was invented in the first place. You're not buying the revolution. You're buying a meticulously packaged, fee-extracting replica of the revolution, sold to you by the very empire it was supposed to overthrow. The Bitcoin ETF isn't an on-ramp to financial freedom. It's an off-ramp from crypto's original destiny. It turns a disruptive protocol into just another asset class in a broker's window, sitting right there between an S&P 500 fund and a corporate bond fund. The true believers, the early adopters, they wanted to build a new system. The ETF marketers just found a brilliant way to sell seats on the old one. using the new system's buzzwords. The scam isn't in the price. The scam is in the promise. And millions are buying it, thinking they're joining a rebellion, when in reality, they're just feeding the king. Thanks for watching.